Hi, and greetings to Dr. Polianki as our lecturer for the subject Financial Accounting SCW 162. We are from Group Blackhole. We will be presenting our company's ratio analysis. So this is our group members consists 10 gentlemen, and this is the division of work that has been set up by our group leader Muhammad Fatul Muaim bin Ahmad. And this is another one.
So our objective is first to assess liquidity, solvency, profitability, and the level of business efficiency. Second is to evaluate before pandemic, which is 2018-2019, and after the pandemic, 2021 performance of the 10 companies. Third is to examine both past and present financial statement in order to assess a company financial health. Fourth, to make report clear for stakeholders so they may assess the operational effectiveness of the company. And lastly, is to analyze corporate governance characteristics of the 10 companies. What is ratio analysis? Ratio analysis is the study of analysis of data found in a company financial position that it can be used to assess various aspects of business, including profitability, liquidity, and solvency, and operational effectiveness. It is a mathematical technique where ratio calculated from data in financials are done to gain understanding to the financial performance and organization. It helps a lot to gain the performance of the company. First is gross margin profit. It's a profitability ratio that compares the gross margin of a company to its revenue. It shows how much profit a company makes after paying off its cost of goods sold. So based on the gross margin profit, it is better when the ratio is higher because it's more favorable. In 2018-2019, from the gross margin profit table above, we can conclude that Unimed Company has the highest percentage of gross margin profit, which is 43%. This means that after Unimed Company pay off his inventory cost, he still has 43% of his revenue to cover his operating costs. While in 2021, CME Company has the highest percentage of margin profit, which is 52%. This means that after CME Company pay off his inventory cost, he still has 52% of his revenue to cover his operating costs, while Unimed Company is still 43%. Second is net profit margin. It's a financial ratio to calculate the percentage of profit company produce from its total revenue. It's measure the amount of net profit a company obtains per RM of revenue gain. A higher ratio is always better than a lower ratio because it means that the company is able to translate more of its sales into profit at the end of period. In 2018-2019, from the table company above, we can conclude that SciPark Company has the highest percentage of net margin, and it is 23%. In other words, SciPark Company has 20% of its revenue left to be utilized either to pay back the shareholder or to reinvest in the business. While in 2021, CME Company has the highest percentage of net profit margin, and it is 60%. This means CME Company has 60% of its revenue left to be utilized either to pay back shareholder or to invest in the business, while SciPark Company only increased to 24%.
So for my part, I will talk about return on total asset, and I will make a conclusion. Which company produce net income the most from return on total asset? So how do we conclude that? Basically, the higher the return on assets, the higher the company will produce net income. So in this case, we can see that Lutz-Chem has the highest percentage, and I can conclude that in 2018, 2019, and 2021, Lutz-Chem has the highest return on total assets, which is 13%. So for every 1 ringgit that Lutz-Chem invested in assets during the years, produced 13 cents of net income. I think that's all from me. Thank you.
For ratio on equity, it is better when the ratio is higher because it is more effective. As we can see, comparison and analysis for 2018-2019 from return on equity table above, we can conclude that SciPark Company, which is Amri Company, has the higher ratio on equity. This means that every ringgit of common shareholders' equity earned about 21 cents this year. In other words, shareholders saw a 21% return on their investment. Next, for 2021, from return on equity table above, we can conclude that UMS Nikon, which is Camaro company, has the higher ratio on equity. This means that every ringgit of common shareholders' equity earned about 25 cents this year. In other words, shareholders saw a 25% return on their investment.
So for the debt ratio is financial ratio that measure the amount of the company total debt relative to its total asset, and is calculated by dividing the company total debt by its total asset, and this is the result. For comparison and analysis, we need to look the lowest one because it shows the business is more stable to pay back the loan. For the year 2018 and 2019, we can see the Hector company has a lowest percentage of the debt ratio, which is 0.08%. And for the year 2021, we can see Minho company has a lowest percentage of debt ratio, which is 4%. And this is show the company will able to pay back his loan and should not have a problem to do that.
Hello, Assalamualaikum and good morning to Dr. Pua and my fellow friends. Okay, our group have been tasked to do a comparison among the 10 companies that we chose before. So my part is I need to do a comparison about the time interest ratio for each company and decide which company have the best ratio among the other companies. Okay, so we go to the next slide. So based on the net interest ratio, if the coverage measurement is above 1, it means that the company has more money to pay the company to get a higher ratio. So based on the data from year of 2018 and 2019, so from the table it shows that the company UMS Naked has the high. It means that the UMS Naked is making enough money from their operation to pay the interest 50 times over. Also, same goes to year of 2021, which is it shows that the company UMS Naked has the highest ratio too. It means that the UMS Naked is enough money from their operation to pay the interest rate 252 times over. That's all for me. Thank you.
For the current ratio, the higher the current ratio, the more capability for the company to pay its short-term liabilities. So as we can see, based on the analysis 2018 and 2019 comparison, it shows that UMS Naked has an average current ratio at the highest, which is 7. This shows that UMS Naked is low in average risk. Ben would prefer a current ratio for at least more than 1 or 2 so that all the current liabilities would be covered by the current asset. For 2031, UMS Naked still have a good current ratio, same as Sang company, which is 8 times its current liabilities are able to pay with its asset.
The acid test or quick ratio is a quality ratio that's ability of a company to pay its current liability when they can do with only quick assets. Quick assets are current assets that can be converted to cash within 19 days or in the short term. Alright, so the higher the ratio, that means that the better the company's liquidity and overall financial health. The asset ratio is used to indicate a company's ability to pay off its current liability without relying on the sale of inventory or and obtain additional financing. So we can see that from 3 years, 2018, 2019, and 2021, UMS Nikon has a high assistance ratio, which means 5, than other company. This means the company quality of financial health and ability to pay its immediate liability.
The inventory turnover ratio is an efficiency ratio that shows how effectively inventory is managed by comparing cost of goods sold with average inventory for a period. In other words, it measures how many times a company sold its total average inventory in ringgit amount during the year. For comparison and analysis, the higher ratio is better because high inventory turnover reduces the amount of capital that they have tied up in their inventory. It also helps increase profitability by increasing the revenue relative to fixed costs such as store leases as well as the cost of labor. But in some cases, high inventory turnover can be a sign of inadequate inventory that is costing the company sell. For year 2018 and 2019, from the table above, we can see that UMS Niken has the highest ratio of 13.92. This shows that UMS can turn over its inventory 31 times a year, or in other words, every 12 days on average during the year. And the last is, as you can see, UMS Niken turnover is 24 for the year 2021. This shows that UMS Niken turnover is inventory 24 times a year or every 50 days on average during the year.
Next, I will explain about account receivable turnover. Account receivable turnover is an efficiency ratio or activity ratio that measures how many times a business can turn its account receivable into cash during the period. For comparison and analysis, a higher ratio will be more favorable because companies are collecting their receivable more frequently throughout the year. For 2018-2019, UMS Niken has the highest account receivable turnover, which is 28. This means that UMS Niken collect its receivable about 28 times a year or once every 13 days. For 2021, UMS Niken has the highest account receivable turnover, which is 27. This means that UMS Niken collect its receivable about 27 times a year or once every 14 days. If a company can collect cash from customers sooner, it will able to use that cash to pay bill and other obligations sooner. Thank you. I pass to next presenter.
Greeting to Dr. Pua and all of my classmates. So my name is Muhammad Zakwan Muhammad Mazir and I represent my group to present about the account payable turnover. So in this slide is the analysis statement and the answer from the analysis that me and my friend already been noted since our 10 analytic company. Before I continue with the company analysis, let me tell a little bit about the account payable turnover. Account payable turnover ratio is a liquidity ratio that shows a company ability to pay off its account payable by comparing net credit purchase to the average account payable during the period. So, in the average of 2018 and 2019, company account payable turnover above. The highest payable turnover ratio is Minho company that being analyzed by site, which is 18 times a year. This is a high turnover ratio, but it should be compared to other company in the same industry. And for the analysis on 2021, company account payable turnover is also above. The highest payable turnover ratio is Minho company that being analyzed by site, which is 15. This means that Minho company pay his vendor back on average 15 times a year. A high turnover ratio can be used to negotiate a favorable credit term in the future. Thank you.
Corporate governance characteristic. First is average of director. Based on 10 company, the structure of the company has director consisting of various ages, 35 being the youngest and 84 being the oldest. Therefore, which average is the most suitable? Young or old director have advantage. Young director can think faster and be more active because they are still young but lacking in experience to make company decision. Therefore, an older director is also necessary because with the experience he is able to make more accurate decisions toward the company.
For the second is number of director. From the company, the most director in the company is 50 and the least is 5. Company with good performance does not because it has more director, and company with low performance does not mean it has few director. Few director are also quite complicated because the work and decision that need to be taken by one direction will increase, which will bring to overload work and efficient work result. While if there are too many directors, it can lead to misinformation and confusion of opinion. Besides, more director will cause higher cost. Therefore, number of director it depends on size of the company to on average. For the last is number of women director. from the analysis, we can conclude that not all company will hire women as an important role in the company, such as director. This is because these roles are very important in the company and can cause adverse effect on the company if the responsibility is not carried out and men are more suitable for this position, and can cause adverse effect on the company if the responsibility is not carried out and men are more suitable for this position. Therefore, the highest average of female director is only 2 and the lowest is 0. Thank you.
In conclusion, the company in 2018, 2019, and 2021 can have a significant change in terms of performance. Why? This is because of the effect of the pandemic, which will make a difference in 2021. This is also because the ratio analysis has a limitation, such as is based on historical cost information and may not be up to date. Besides, it's difficult to make a comparison when the types and nature of business vary among companies. So, the decision made by CEO and director is very important towards future company performance. And that's all from me and our group. Thank you.